Hi, this is lecture 2.3, where we're going to talk a little about the generally accepted accounting principles and other accounting standards and elements that we need to consider as we go through our accounting routines. Let's start by objectives of financial reporting. So we talked a little bit about why we provide our financial statements, and again, just to kind of recap, we want to provide information that's useful to external individuals as well as internal. So on the external side, potential investors, lenders, and creditors, potential suppliers and customers. On the internal side, internal decision makers and internal stakeholders. And again, this information that we want to provide is going to give, help people make decisions around whether they should buy into our company or invest in our company, whether they should lend funds to us and things like that. And so in order for this information to be really relevant to those individuals, there's a few characteristics of financial reporting that we always need to keep in the back of our head and we need to ascribe to. Just as we all ascribe to rules on the road, it's important that, if you get in the road in a different country, that you've got some similar signs, similar practices that can translate beyond different cities, countries, and continents even. So very, very similar with accounting information. We want to provide some baseline knowledge, some baseline realities that are going to apply to all of our financial reporting. Okay. So first I want to talk a little about the qualitative characteristics of information. So as we look at what we present in our financial statements and what we record, there's a couple of very important sort of characteristics of all the information. The first is relevance. So we have to have relevant information presented so that people can make decisions. So we need to judge whether something is relative or not based on if it has any kind of predictive value. So is it relevant in that knowing this information is going to help us understand where the company is going? Or a confirmatory value, where again it's relevant in that we can confirm that the company is actually doing what it's doing, or it's at a certain valuation. So again, we can either confirm with that information, or we can use that information to predict something in the future. Another characteristic is what we call materiality, which is that it's got enough importance, it makes enough of a difference that it might influence a decision maker's choice. So again, if we're looking at a company that has $1 million operating revenue, if we have a bad debt or a customer who's not going to pay us, and that customer owes us $800,000, that's very material. We need to present that information to our readers of financial statements. Whether that's in indicating that we have a potential debt that won't be repaid in our liability section, or indicating that in our notes to financial statement to readers of the financial statement. We want to make sure that information, because it's material, is conveyed to the reader, as opposed to if we have a customer who owes us $50 over $1 million income. That's not quite as material. We may not have to present that in the same way. We should still present it because it's actual fact, but we may not have to draw people's attention to it. It's not as material or as important to potential decisions they may be making. The next qualitative characteristic is faithful representation, which basically says that the information that we put into these financial statements needs to be complete, needs to be verifiable, and needs to be free from error. So the numbers we put in there need to be accurate and reliable. So there's some qualities that we can ensure that we sort of communicate through those characteristics. So we want to be able to have information be very comparable. So we can identify items from one year to the next year. We can identify between one company to another different elements of the financial reporting. And so we follow our standards. So as we looked at the financial statements in our last module, we have certain forms that these all sort of ascribe to, and that helps us to kind of have comparability. it's easy to identify the information and easy to compare between different timelines and between different companies. We also want to have this internally comparability as we think about the types of accounts that get classified as revenues and expenses. We want to have that sort of base knowledge that across all of our companies, those elements should be very comparable, those definitions. The next element for useful information is verifiability. So again, it means that the information that we've put in there is accurate, free of errors, and that we can actually verify it through source documents. So if we have an expense listed, we should be able to go and find the actual invoice that was paid by our company. Timeliness is another important one. So again, we want to present the information as quickly as possible so that if there's decisions that should be made, they can be made with the most accurate and up-to-date information as possible. If we wait 6 months to report a new client that's going to bring revenues of millions of dollars, if we wait to report that or wait to 6 months after we've collected that revenue to put it on our books, we've lost a lot of usefulness in our decision making. That could have factored into some decisions we would have made ahead of time. So we want to make sure that our information is communicated in a timely manner. Last but not least, and very important in this course, is understandability. So we want to have things classified and characterized as clearly as possible and as concisely as possible, again, so that we can look and quickly understand what it is that we're reading. Okay, there's an underlying cost constraint value in here as well. Basically, we need to ensure that if there's a piece of information that we want to present or that we're going to present to an individual reading our financial statements, the cost of figuring out what that number is should outweigh the value that it presents. So again, we shouldn't have to spend a lot of money to report something that really doesn't have any value to shareholders. The next assumption we use is what we call the going concern assumption, and typically this is something that that we should fundamentally adhere to. And what it says is that as we're going through our accounting process, we should always be assuming that the business is going to continue to operate, and that everything that's happening today is for continued operations. We shouldn't start to discount things on a fire sale because we think we're going to go bankrupt in a year. Things should continue to have the market value of the cost value of our assets and the ongoing information that's true and accurate, as if we were going to continue operating. Okay, we're going to talk about some of the elements of financial statements. Again, we kind of walked through these in the last module, and we'll continue to work through them in the coming modules. But again, the elements are all consistent: assets, liabilities, equities, revenues, and expenses. And what's important is, as we decide what number goes in there, we have to have some principles that tell us, how do we measure what these things are? And so we call these generally accepted accounting principles, and they have guidelines or principles that tell us when we should recognize a transaction, how we should measure the transaction, and how it should be reported. So first, as we think about how it should be measured, we look at two principles called historic cost or fair value. Now, historical cost is typically what we record all assets at and liabilities, and that's basically at the cost that was incurred. So if we go out and buy an asset today, the cost that we paid for it, that's going to be what our asset is listed on our books. The same thing for liabilities, not only at the time of purchase, but throughout the life of each asset and liability. So that value isn't going to change over time. If we buy a car today for $35,000, we all know tomorrow it's not going to be worth that much. But on our financial statements, that historic cost is the most reliable sort of source. We know exactly how much we paid for it. How much it's worth in a year's time is based on a number of factors, based on the usage, the mileage, the condition of the vehicle, the geographic location we're in, all of those different things will sort of factor into our fair market value or how much someone else would pay for it. And none of those things are overly reliable at that point. And so we default to measuring our assets and liabilities at historic cost for the life of that asset. We do make some qualifications or justifications to reduce that cost over time. We'll talk about that in a later section, but for the most part, our assets and liabilities are always going to be listed at historical cost, or the cost that we acquired them at. There may be times when we look at the fair value. So some assets should be recorded at their fair value or what the market would pay. But again, when we go down that road to what fair value is, we need to be sure that the person who's dictating what that value is has some credibility, has knowledge, and is able to verify with some degree of certainty what that fair value is. Okay. The last element of this module is talking about the differences between international financial reporting standards and accounting standards for private enterprise, further known as IFRS and ASPE. So when we look at, primarily our focus in this course will be under standards in IFRS, which relate to publicly traded corporations and private corporations. So corporations that aren't traded can use either. They can have a choice. But for the purposes of this course, most of what we use will fall under IFRS. If we have private corporations, we can choose between the two. But again, once that choice is made, we want to make sure that every year we follow the same standard. Again, for that comparability from year to year to year. Okay. There are a few differences in both standards, and as we go through the course, we're going to talk a little bit about those differences. Each of them have some different terminology and some different inclusions or exclusions among our different reportings. So we'll talk about some of those differences as we go through the course. All right, that's it for lecture 2.3. Hopefully the course is going well, and happy studying. Take care.